Good morning, ladies and gentlemen. Well, in terms of risk, nothing at all has changed in the past week. We closed at 58 on the risk dial, which is exactly where we closed the week before. The moving averages keep on going out ever so slightly. It's very marginal. And if we look at the weekly score, exactly the same as we closed before. So there is really nothing at all new that is going on in risk. The spreads are very, very stable. If we start looking at where the S&P 500 is and the forward earnings on the Blue Angels, we'll see that they're absolutely flat, and all that is happening is multiple expansion. Can we get, this is a monthly chart, so you can see back in the 90s when we got to something like 25 times multiples. Is it possible that we get there again? Yes, of course it is, but it's unlikely. I think the risk reward is not there. If we look down on the daily, we will see that we are now pushing levels which are extreme, and that should always caution our approach. And you will see later that the monthly, the weekly, and even the dailies are saying that the S&P is going to be in a bit of a range for quite some time. If we look at the bonds, we should be able to realize why risk is not moving anywhere. I mean, this is the 2-year note, and basically it has been here in this range for, what is it, months now. So it's understandable. We are basically trading 160. What do you want to do? 10 basis points either side. 151, 168 is your effective range in the 2-year note. If you have a look at the tens against the twos, this is a chart of 10-year note yield against the 2-year note yield. We are now basically in this kind of range, 13 basis points to 30 basis points. And as we push up, the XLF tends to do better. As we push down, and as I think we probably will over the next few sessions, XLF tends to do worse. But, this kind of level is around 20 basis points, only 4 basis points from here is probably a decent risk reward to start looking for the upside again. In Germany, that is the big difference. We keep on pushing these upper ranges, which are quite like -48 in the Bobble, and in the Bund we are pushing constantly this -22. If we start closing above -22, -7, -6, this kind of level is likely. So the curve is steepening in Germany, and yields are pushing up in Germany, which you can really see from the US 10-year versus Germany chart. If it comes up, just a second. Yes, here it is. I've inverted it, so you see it going down. Well, this 196 basis point is going to be key, but at the moment we're still around the 208. And to me, if we start pushing this -196 level, you are bound to see some weakening in the DXY. And that would be bullish for EEM, but I don't think that we are in this kind of a trend yet. I think this is a holding pattern. We can't go above 220. We're not really going anywhere at all away from 208, and 196 is extreme. 196 would actually be a good level for risk reward to see a move back up towards at least 210. In the other yield charts, absolutely nothing has changed. This is the fives. You can see what a wonderful level this 1.77 is. If we get up there, great risk reward. Those levels are all in the bias in the bias sheet. It's just a wonderful level, anywhere between 177 and 187 for a move back down. The Fed is not going to be doing anything here. If we then look at the 10-year note, where are we? We are we are at the levels that we've always talked about. 203 is the kind of level that maximum you should be expecting in the 10-year notes. What a wonderful risk reward level to trade some for the lower bias. And even if we look at the 30-year note, which is like the closest proxy for the equities, you can see that what did we do in the yields last week? We closed a couple basis points different. It's so stable that encourages multiple expansion. We really need to see at least a retest of this 0.382 retracement around the 250 level, this kind of level, to see any kind of weakness, I think, in equities, and people doubting the multiple expansion story. But even that might not be enough. So while the market is so stable that it moves 1 or 2 basis points a week and then retraces and basically says that 30-year notes are as stable as anything in yield, it's unlikely that we go anywhere. This is TLT, and as you can see, all we did in TLT is we moved not even 20 ticks. I mean, it's so stable, it's not true. I really would like to see it below 132.08 to even start thinking that equities can retrace a sizable amount. Our friend the dollar, who likes to frustrate absolutely everyone, is doing it again, but it's proving certain things. It's proving the validity of the 96.50 level, and it's also proving the validity of 97.52, 97.87, and finally 98.33. Those are the levels. So basically anywhere between 97.87 and 98.33, it's well worth giving it a shot on the downside, simply because A, they are very important technical levels, and B, because it is quite obvious that the medium-term trend is for the yields to come in and for the differential between the US and Germany to come in, and that should be dollar bearish. But the trend is not there yet. If we look at Euro USD, we're still below a downward sloping 200-day moving average in the 200s. The 50-day moving average is sloping down as well. So I would expect, tests around this 110.50 area and then reactions higher, which would basically coincide with those moves in those levels in DXY that I showed you earlier. So really the trend in the dollar is not established as yet. And if we don't have established trends lower in the dollar, it's probably premature to start expecting things like EEM to start outperforming the developed markets in a pronounced fashion. Gold closed, what is it, a couple of dollars higher than last week. It's right at the Bollinger Bands. It needs time to go higher. Basically everything is saying that there are going to be no big moves, and all the big moves are going to be retraced. That's what the markets are saying at at this moment. If we look at a 300-minute chart, it's it's looking better, but I'd expect this to become an ABC down towards this 15-20 area at some stage. By then the longer term moving averages will have caught up and it can start going up again. Gold and the dollar are both saying not yet. The move is not going to start going at anytime soon. We have time to get into position, probably at better levels in both. The equities are in no doubt still in an uptrend. We got overbought in all time frames, and we are now slowly descending. What are going to be the key levels for next week? Well, really, if it stays above this kind of area, 345 to 350, this has been nothing but a small consolidation phase, and we push the highs again. If we look at it in different time frames, it's very much the same. This is a daily chart, and we pushed down to the first moving average, but really while it stays above this mauve one, which is 32.45, and ascending towards 32.50, that's it. It's just a tiny little dent in the major trend. It's not until we get below this red one, which is now 32.10, probably 32.20, 25 by Monday, Tuesday, that we will, that will be the first sign of danger. And even then, what are we looking for? We're looking for this kind of level around 31.75, 80 again. 31.80, I believe, is the low for this month. I've told you before that the market tends to retrace to the Bollinger Bands on the monthlies, and we'll see that in a second. And that's what it did, and it absolutely screamed higher, didn't it? 100 points in 2 sessions. So that is again what you can probably expect. If we look at other time frames, here we have the weekly. It's quite obvious to me that this kind of level is going to be very difficult to break around the 31.80, 85. Still ascending, still no reason to change one's mind, as the risk spreads are saying. Absolutely no reason to doubt that we are in a risk-on move. If we have a look at the monthlies, well, we are just crawling along the top of the Bollinger Bands, which is very impressive. I mean, I am impressed. This is the kind of move we got in the early 90s and kept on going and kept on going and kept on going. Unless you are trading this in your trading account, sure, look for good levels to look for, 30, 40 point pullbacks, but in your investment account, you are looking for nothing but levels to get long at. This picture is no different in the other developed markets in terms of equities. This is the DAX on a weekly basis. On a monthly basis. You will see that we have resistance around the 13,655. I'd be surprised if it gets above there. But while it's staying in these ranges, it's just not bearish in any way. If we look at the Nikkei, while it's between 23,000 and 24,150, it's impossible to be bearish of it. All you're looking for is levels to get long, for breaks above 24,150 to be in a very strong trend. This could, after 2-3 more sideways candles, this could become a very impressive break to the upside should it materialize, and then we're probably looking for another 2,000, 3,000 points on top of 24,000. Let's not get ahead of ourselves. I really like Japan because it's so underowned, and there is really no reason to be bearish of it. So this is the one I'm keeping a close eye on, and that I prefer to SPX in many ways. But what do I know? There is just not a single equity market out there that is giving you reasons for concern. We should pay very good attention to EEM. this is a monthly chart, and you can see how it's right at the top of the monthly Bollinger Band. Every time it's done that on top and bottom, you can see how many attempts there have been. It's reversed hard towards the middle, and the middle is around the 42.20 area. The risk reward in EEM is becoming not great, is it? Simply because we have these technical confluences, but we also have the lack of trend in the dollar. And that to me is concerning, to hold too much EM at these levels. The risk reward is poor. I would much prefer a strong candle this month which closes above the Bollinger Bands, and then for it to hold for a couple of months and then to go. It needs to confirm this kind of a strength, because otherwise the risk that it comes straight back down towards the 42 area is far too high. But there is no doubt that around this 42 area it's going to be a wonderful buy. You can see how nicely set up the moving averages and the weeklies are, and on the dailies they're very nicely set up too. So this kind of a move back down by 3-4% is going to be a wonderful buying opportunity, and that is why I'm moderately long of EM. I'm hoping against hope for a move back to the mid 42s or low 42s, and there I'm much more prepared to give it a go. This should coincide with a few more weeks of dollar indecision, dollar strength, before DXY starts turning down and a break of that very important 95.50 level. I really want to see a conjunction of a break of that 95.50 level in DXY to get massively long of EEM. To me, the picture in equities is made all the clearer by the picture in volatility. Until we see a close above 1627, there is absolutely no reason to believe that we are seeing anything but technical retracements, and that the trend is still bullish and up in equities. This is not a bullish setup to me for volatility. I think we are in a range. Really 1136 is the low, and 1625, 1627 is the high. While we're within that, we are range trading, stroke going higher, stroke expanding multiples. So that is all I have to say about it. Use 1627 as a trigger. I certainly will. Until it closes above there, we are not in any kind of risk-off situation, apart from the very minimum kind of risk-off, which is profit-taking. The biases for next week are very much the same as the ones for the weeks before. We have all these very important and clear levels in 2s, 5s, the yield curve, Bobble, Bund. These are very clear levels. If the market starts trading through them, we know something is changing. But until that happens, nothing is changing, and really the outlook for volatility is low. I think we have seen the bottom at 31.18 SPX. That was the level that I was calling for. We got it. It's not really going to go very much lower than that, I don't think, unless we see developments in the yields, and we're not seeing them. 32.40 now becomes key next week. Should it dip there, I think I'm definitely going to be a buyer. VX, I told you what I think. I'm a seller of those rallies because I think we're still in risk on. European equities and EM, the risk reward here for EM I think is poor, but I'm going to remain small long and see what happens, with the hope that when it comes back towards 42.20 I can really increase my position. DXY, 97.70 I'd love to see for the swing level, but 95.50 is the key. And why bother? The DX has been in a very frustrating range for such a long time. Let it finally break 95.50 and then we can do something, or we do it at the 97.70 swing level. Thank you very much indeed, and tweet you on Monday.